Um, yeah, can I share my screen? Yeah, hi. Good evening, everyone. This is Bhavin. I have my colleagues and the team members also on the line. Thank you for joining this call today. We like to interact with investors on at least a couple of times a year, I would say. And uh, I have today what we would do is I'll go through an update on our funds and then go into the questions. We have received a large number of questions, and then thank you for that. And we have uh, categorized them into different topics, and I think we will address them by topic. So, just uh, first of all, the I think just to remind everyone, we have offered three different vehicles to invest into Indian equities. And that is the PMS, as well as domestic AIF, and also recently launched AIF in Gift City, which allows the investors outside India to invest into India into our same strategy. The portfolios are by and large the same. There are some minor differences in terms of possibilities with for the AIFs, but overall the portfolios are very similar. Um, so I think just a quick update on the markets. I mean, I think Indian this is sort of a more of a long-term perspective, and I think it helps sometimes to look at this. Indian markets have done obviously fairly well, and I think this chart is what this table is trying to show is that Indian equities remains one of the best investment classes when looked at in US dollar terms. And I think it has done, in fact, much better than even the US S&P 500 over a 10 and 20-year period. So I think that's kind of important to remind. Uh, so where we are, I think there's obviously a lot of questions on the markets and outlook. And I think this is sort of our way of looking at things in a more of a very high level summary of the markets. Clearly, the idea here is that we looked at various parameters, the P multiple that a lot of people look at, but on top of that, in addition to that, we look at the price to book multiple, which is also important, and then we look at some specialized ratios, which kind of put together the profitability of the companies, return on equity, price to book, and the interest rates, and we call it Sameeksha ratio, for example. There is also the ratio of bond yields to earnings yield, which is also looked by many people. And then obviously the parameters such as inflation and so on are important. And I think what this tells you is that depending on whether you look at the market as a whole or a large cap or mid cap, small cap, we're clearly not in a very attractive area on a simple P and price to book basis. However, What has changed, I think, over the years is that the quality of the companies that comprise this indices have improved significantly. And I think so when you bring that return on equity into the picture and the interest rate, actually the Indian markets are still reasonably valued from that perspective on market as a whole. Obviously, individual stocks, we have to be very careful. The other important thing is that inflation is clearly, very reasonable. And all the other important indicators for the Indian economy are very robust. And hopefully with a stability in the government post-election, I think we could see very strong undercurrents in the economy. So that is sort of our present view of the world. I'll go into some of the questions later. And I think on the US market, Ishwar, you want to touch a base, just to touch base on that right now? Well, the more specific questions we can go later, but since the slide is there is the US market here.
Yeah, just at a high level, I think the US is, obviously the biggest economy in the world. The US among developed markets, if you were to compare it with Europe, compare it with developed Asia, Japan, Hong Kong, Australia, etc., the US economy continues to outperform. If you look at the last couple of years post-COVID, just a few drivers. First of all, one area of concern with long term is just US spending. I think US spending continues to be high. The incremental debt every year is quite high. So I'll put that as an area of concern. On the other hand, it's a very innovative economy. If you look at, if you go back about a year when, ChatGPT came out, etc., I think US companies, mostly the large cap technology companies, continue to be leaders in terms of, another innovation. And this is kind of continuing a trend. And AI related spending is quite high. So if I look at things which are supporting the economy, people often talk about the US consumer, which has been strong. But I think AI related spending and government spending also has been high. So the U.S. economy continues to, be quite strong. Debt is a concern, as I mentioned. Inflation remains a bit stickier. When we talked about inflation going back to post-COVID, we always thought that a good element of it was transient. As it turned out, it did come down substantially, but it's remaining a bit sticky, kind of at the 3% level. So we'll have to kind of see, and that I think what the message market takes away from that is that maybe bond yields stay a bit higher than they've been historically. So if inflation is 2.5 to 3% versus kind of 2% that you've had for most of the last 20 years, maybe bond yields stay a bit higher, combined with, obviously the higher levels of debt. So in terms of valuation, I think certain pockets, particularly anything which is AI related, you're seeing valuation at a premium to historical, as you can see in this chart, for example, the Schiller PE, the trailing, PE, both of those remain quite high. But the market also is very unforgiving. If you're a company which doesn't deliver, you don't meet expectations, for example, you see stocks getting crushed, right? So in a way, that efficiency remains. If you deliver, you get a premium valuation. If you don't, your valuation goes down. So many parts of the stock market, for example, valuation remains compelling. So not across the board. So very broadly, we don't see any breaks in terms of the economy. Recently, for example, consumer spending, if you look at companies like Starbucks, for example, suggests certain weakness ahead. But it's still too early to say whether you're going to see a downturn in the economy, especially a significant downturn. At this point, we don't see it, but we continue to monitor to the extent that it is very relevant for all global markets, including India.
Thanks,
Back to
Ishwar.
you. Yeah.
So just to touch base on the performance, a few words on our performance so far. So I think this is as of end of April for the PMS and end of March for AIF. We continue to have delivered very strong performance. In fact, as of end of April, I think among all the multi-cap PMSs, this was the highest in India. And for the 5-year performance, even our last 1 year performance has been very strong. So I think across various time periods, I think we have been able to maintain very strong performance. I think since inception also, and I think it suggests a meaningful outperformance over the Indian market as well as the US market in dollar terms. For the current financial year that just started, obviously this is just 1 month. It was a strong month for us. Obviously, we are seeing correction in this month, in month of May, and I think some of these upside outperform some of the positive performance is getting wiped out, but we still are doing better than than the benchmark, is what I can see. The other thing I would like to draw your attention is some of the ratios that measure the risk. So how do we do in the up markets and how do we do in the down markets? And I think what we are trying to show, I mean, what the data is showing for our performance for last 5 years is that while our upside capture is more than 100, meaning that if market is up 100, we are up 100, if market is up, 100%, we are up 111%. Our downside capture is very low, which means that we go down far less in the down markets. And I think, in fact, this is, I think that I think is an important characteristic that we have seen in the past for our portfolio. And I think just a couple of other words on the portfolio performance. We have maintained our 100% top decile ranking track record for a rolling 5-year periods, and now there are 38 such periods that we have completed. Every month is one new period for previous 5 years, and we continue to have that top 10% decile or top decile performance recorded. Um, and also in terms of the clients who joined us at different point in time, we have been able to deliver alpha or outperformance across almost all the time periods, except for the clients who joined us in recent periods. And I think this is important, and I think it also relates to one of the questions that were raised. So I'll cover this again when we go through the questions, what has happened in the last 6 months. So I think let me switch to the questions now. Um, and so the first set of questions, obviously around the Indian elections, and what's going to happen, and what's the how do the market expected to perform till the 4th of June and after results, and then over next year, and so on and so forth. Also question, if the NDA doesn't get majority, how do you see market performing? So, I mean, I think, see, the stock market is something that, in a stock market, 1 month can be a very long time. Yeah, I think as we have seen last 3, 4 days, the market has been weak because perhaps, partly maybe because some concerns about the size of the majority. I think it's very, difficult to gauge what's going to be the outcome. Obviously, all the opinion polls prior to the election were giving a clear majority to NDA. Now, if let's assume that I mean, I think we don't have any strong view on what exactly will happen in the near term. But depending on what happens in near term before the 4th of June will determine how the market reacts post 4th of June. So if the market has already corrected a bit, I think then obviously the reaction post that would not be as meaningful as it would be if it came as a big negative surprise. I think one thing is very clear that the track record of NDA has been very strong in terms of at least been from a market perspective and economic growth perspective. They've been very focused on doing whatever various things to create productive capacity in the economy, investing in infrastructure and doing, and many other things. And I think if there is a change, then obviously there will be huge concerns on how the new government will fall. And I think there is clearly an important risk to the market. Our view based on whatever we have heard and read so far is, that such a, if you don't expect such a big negative surprise, but yes, that risk is there. Uh, I think the other questions related to what is the estimate for Nifty over next 5 years, 5 to 10 year horizons next year. and re return expectations from Nifty, realistic return expectations. So the questions around what returns to expect in future. So it helps to look at the data, what has happened in the past. And if you look at last 5 years, the Nifty returns have been significantly higher than the nominal GDP growth rate. So nominal GDP growth is a very important sort of kind of number we can use to anticipate the growth rate in the equity market. So I think there was a meaningful delta. The mark, Nifty growth, Nifty TRI was, Nifty CAGR was 15% over the last 5 years versus GDP growth of nominal GDP growth of 9.4% on a annualized basis. So there was a sufficient significant delta between the two, and I think it is possible that we actually uh, do not see that kind of delta going forward. We might even have to see some reversal of that basis. Now, I think it is realistic if we have a growth-oriented government to see, and I think if it's continuation of the policies that we have seen in the last few years, that it is very possible to see 7 to 8% real GDP growth. And if you add maybe even just 4% inflation on top of that, a nominal GDP growth of 12% or something like that is not unrealistic. Normally, the markets historically at least have delivered slightly better growth than that. But if you are if you are had a meaningful gap, much higher market appreciation than the GDP growth in the past, maybe there will be a little bit of mean reversion. So I think it is not unrealistic to expect low teens kind of a market returns going forward over next several years. And I think the more important thing here is how long can this sustain? And if you look at China, it went from, in the period, it went from, say, $2,500 GDP per capita to today, which may be, depending on, which numbers we look at, maybe 12,000, maybe $13,000 GDP per capita. Some numbers might be even a bit higher. I think that journey was a very long journey over, maybe a couple of decades. And in that journey, they consistently delivered very high GDP growth. And I think India has that potential because, we have the demographics in favor. The working age population still young and grow, and that population is still growing. And I think if policies are right, I think other investments are made in the productive capacity in education and so on and so forth. We could have a very long period of high growth and basically double digit nominal GDP growth. So I think that is the perspective that one should have on the Indian equities. And beyond that also, I think as US equities have shown to us, I think if there is a lot of focus on innovation, I think this the technology, which I think India is beginning to show signs of doing. I think we could have sustained strong economic market returns even beyond that. One of the things I would say is that Indian market is quite unique in the world. I had my first opportunity to analyze different countries way back in 1996 when I looked at the return on capital of companies in India in various markets and how the market valued companies with superior return on capital. And India stood out actually, even in 1996. This was just few years after liberalization. And I think if you look at the returns of the Indian market between 1996 and today, they have been quite strong. And India stood out along with US. So I think Indian market we are fortunate to be in a country which has a very strong corporate culture. Companies focused on generating profitable growth, and I think that reasonable corporate governance. Enough number of companies that have good quality of corporate governance and a large local market to grow into, and then obviously many companies have global opportunities as well. So I would say that we are extremely bullish on the opportunity for Indian equities from a longer term perspective. But I think near term, one has to taper the expectations given the run up we had. And I think, so if next 12 months we see subdued returns after what we saw for March 24, then I think it is only reasonable that that happens. But I think, one has to stay focused on the long-term opportunity. Um, I think people were asking what sort of alpha target Sameeksha has, in other words, outperformance targets, and if a new investor who's joined, what should they expect? So first of all, we don't have any alpha target. We can, as we can, I think I shared a little bit of data, and I think we have shared that data before as well, and it's available anytime in the sums of what is our has been our outperformance over different periods of time, and I think we have delivered consistent outperformance in the past, and I think we see the opportunity to do so, but it is easier said than done, and I think it requires uh, working to identify companies that will deliver superior returns. And, that is the work that we do every day. We invest heavily to, basically to make sure we are positioned to identify such companies. And when I say invest heavily, I mean having a, strong research team and also having good technology capability so that we are able to work in this area. And I think the endeavor will remain to keep doing what we have been doing last 8+ years. And also another important aspect of alpha is that don't chase assets. We are not interested in building a very very large AUM, which I think is very easy to do once firm like us has delivered performance in the past. But that's not going to be our focus. Our focus is going to be on managing the growth and working towards delivering alpha in future as well. So I won't be able to give any specific targets, but I think we'll continue to evaluate the companies the same way as we have in the past. And the other thing, as far as the new investor goes, I mean, I think it is always it's the most important thing to remember is if you're invested in PMS is that we don't follow a model portfolio approach, and I think so. You'll see, and that works both ways. If the market rallies quickly after you join, you may underperform, and if market, however, corrects, then we might be able to pick some stocks at a lower prices in your portfolio. If you're a AIF investor, then obviously it is. You are entering into a portfolio. But however, in an AIF also, we would try to, basically exit positions which are fully valued and also take necessary action from time to time to basically manage risk. So that's, what we try to do. And hopefully as long as, our endeavor will be to sustain performance. That's all I can say. Um, the question around the elections coming up, does our investment strategy get affected? Do we take any advantage of short-term opportunities or stick to fundamentals? And I mean, I think we are not good at really investing with a very short-term opportunity unless it's a very clear opportunity, some kind of a event arbitrage, or some grossly undervalued situation. And I think I can give an example when all the bad news, the whole Hindenburg scandal came out about Adani Group. We have historically not invested in that group, but Adani Port is a very robust business. Although with some questions on their accounting or rather or corporate government, some of the related party transactions. But it was available at such an attractive price that we saw very favorable risk reward, and so we took a short term view on that and invested in that. So yeah, sometimes when we find such opportunities, we don't mind. If it's a very very clear cut risk reward that is favorable, we would take advantage of that. Elections. Well, we if we had a view based on whatever we can see that the election outcome may not be favorable from a market perspective, then obviously we would act on it. Obviously it's very hard to do, but I think so far, as I said, we haven't felt the need to do so. There was a question also on the geopolitical situation. And again, I think the geopolitical situation, one has to look at what it means for India, whether it's the situation somewhere far, in say Russia or Middle East. and whether or not, it has a potential to have big impact on things that matter to India. And obviously, one of the most important things that we have to worry about is crude. We are importers of crude, and crude oil prices obviously affect us negative. Rise in crude oil prices broadly affect us negatively. So one can pay attention to that, but I think again, it is not. Those are not the events that we would try to make big swings in the portfolio. Yes, if there was a geopolitical event on our border, that was likely to kind of escalate into something, then we may want to act on it. And so that's kind of the how I would look at that. There is a question around, what is the risk mitigation in case a non-BJP government comes to power? Well, I guess, it is hard to, we have not taken that call. We are reluctant to take that call today because I think that probability is extremely low. But I think, if there are any reasons for us to believe that that's going to happen, or if it's, seems like it is happening, we may act on that on that particular day, to the extent possible. Um, Market cap bias of the portfolio shifting over the next few months. So we had a pretty high exposure to small cap. If I go back, September last year, I think we peaked in August 23. Actually, we peaked at around 68%. It has come down to around 55%. So it has come off in terms of the small cap bias. And I think it is a function of opportunities more so than anything else. I think a few months back there was a lot of chat about, the 2018 repeat that, small caps, have done too much, and now there will be a prolonged correction. While we saw the argument for valuation, frankly, we didn't have that many, as much of exposure to very richly valued stocks in our portfolio, except maybe a couple of situations. And second is that what I feel is different about today, 2024 versus 2018, is that the quality of the small cap universe has improved significantly. And I think so, it is not that it is just, just a wave that has driven all the small cap stocks. So I think we would sort of look at that, and that's why we have not really made a huge swing, although, wherever we thought it would be worth booking exiting, that we have done that. And that's why the small cap exposure has come off. Will it come down more? I mean, I don't know. I mean, I think it is hard for me to, say that, because I don't see any real, like, uh, reason to make a big swing, is what I was saying. Um, so in terms of our investment approach in current volatility, and I think obviously we are seeing volatility last few days. I mean, I think and I think, I can say that, for example, having seen the number of results in the IT sector, we've and listening to what is happening, and what I feel is that companies are feeling the pain uh, from the US customer base, and I think we have taken some decision around that. So where we see where we see some underlying trend, we would take those chances. I mean, we will take those decisions. But I think other than that, the current, I think the thing to do is to look at every position in the portfolio and see what has changed around their fundamentals. And if something is not working, or it look like we will probably not have, we won't see much returns, in the next 12 months or 18 months, then we would obviously take action around that, is what I would say. Are there any opportunities to invest at current levels? It is hard. I don't think, I think when we look around and keep evaluating. So one thing that we do is we keep evaluating new opportunities. And at any given point in time, we might be evaluating six, seven, eight new opportunities, because that's kind of the number of stocks that we might be looking at any given time. And I think what I have observed is that, today, if we look at 10, maybe one might be worth investing or meet our criteria, especially on the valuation. So yes, it is harder to find opportunities. But I think, we have to just keep looking around, and I think eventually these opportunities do keep coming, especially when an economy is growing at 7-8% in real terms, and low double digits and nominal terms, and with investments in wide range of sectors, enabling factors for wide range of sectors, I think opportunities are going to be there. We just have to keep trying to find them and analyze those situations. Any plans to take larger cash position? I mean, again, uh, I think yeah, there is always a possibility to do that if it warrants. I think we have. I think last few days, I think there has been little bit of an increase because we have sold a few things. So yeah, so in that sense, there has been some increase in cash exposure. I think yeah, we will evaluate things, and if required, we would increase the cash position. Um, Going into some other set of asset allocation questions, is PMS investment more risky than Sensex or Nifty mutual fund? Um, I mean, I think it depends on the PMS and strategy. I think shared with you some data that show that we have had much lower downside capture than the market. In other words, our portfolio has been less volatile than the market, and our beta, which is the correlation with the market, has been 0.8. So less than 1 means that it's less volatile than the market. So at least in our case, we have been able to deliver performance that is higher than the market at a volatility that is lower than the market. And I think this is a very important question that you should ask when you are evaluating any investment, is not only the return but the risk or the volatility. And I think we have been sharing this data ever since we started publishing our performance data. You don't see that often shared by many other funds, but we believe that this is an important piece of data that investors should look at, and we do share those data. Um, how should we think about investing more money in this market condition? I think what whoever has asked me this question, number one, I would say it's really boils down to individual situation, financial planning. But from a point of view of entry, it's a uh, what I've suggested to some people is that you stagger your investments given where the market is, because but don't completely stay out of it, because, or don't wait for the best opportunity, because it is difficult to time the market. So if the valuations are high, maybe one can do a staggered approach, is what I would have been suggesting. So yeah, the similar question, would it make sense to do lump sum or staggered? So I think what we provide options where you can give lump sum and then give us the instructions to do it on a staggered basis. At least in PMS, it's possible to do. And I think so basically systematic investment plan is something we can put together for you, and so that way you don't have to worry, think about how much I invest, this month, next month. It's a plan that we have set up, and then you basically benefit from the kind of the dollar cost averaging, as it is called, or rupee cost averaging, you can say, is what I would say. Because then I think the thing is that because of the way we invest, if we have money, in your portfolio, then if the market corrects, we might be able to deploy it quickly, and you may not remember to do so. So I think that's why that's what I would suggest. I think the other questions around some of the things related to our future plans. So having Sameeksha's AUM has increased, has it affected the choices? Has it affected the choices we have for investing over last few months versus last few years? I think so. If I go back to say maybe a year and a half ago versus now, we allowed ourselves to have own a little bit more, few more stocks. So we increased our portfolio to 35 stocks. I think we probably could still increase that further if required. I think the investment capacity, and we did some analysis around this. And I think there is still significant investment capacity. I mean, we are very, very small in a context of the Indian equities market, and the opportunities are, opportunity set is quite big in terms of, we have, in fact, if I look at our portfolio over the last few years, we haven't had to take large positions, even in the names where we had high conviction, because we had plenty of opportunities. we could easily increase the portfolio position sizes in some of the liquid names. And our largest position today is like around what 9% or something. Whereas in the past we have taken bigger positions than that as well. So there is that option as well for us to manage the AUM size, and so that's I think that's I think one option. Second, as I said, is basically to have a little bit more flexibility around number of names, although we don't we haven't done that yet. Third thing is that while we do not like to invest in blocks, I think where the conviction is and price seems very reasonable, we can also find opportunity to invest through blocks. And I think and in here also, that could also give us some more flexibility to manage a slightly larger AUM. Um, but I think the question is whether we will tilt more towards large cap. I don't think that is going to be necessary. I think, as I said, in some large cap we might take slightly bigger positions. I think, but only if the returns look very attractive. And I think if it comes down to a situation where we are really struggling because of the size, then we will think about some other decisions that we take around new money. I think some people asked us about how do we create a solution for PMS investors to take advantage of IPO opportunities, because we can only do it under AIF. Now, the problem here is that we while we can technically invest in an IPO in PMS, it is practically not possible because if we subscribe to an IPO and any of one of our investor also subscribes, then both applications get rejected. And so that's why we simply don't do IPO in PMS. We have been making representation to SEBI, to change some rules around this, so that we are categorized as an institutional investor, and that solves this problem. And I don't know when the SEBI will agree to a change, but that is where we are. But we do evaluate IPOs, and sometimes we are invested in the stocks post the listing. And I think so. We would participate. If the price is right. So that is what we have seen. Um, there was a question around learnings from last year. Well, I mean, obviously our portfolio did extremely well last year. I think our 1 year performance also was, pretty strong in terms of the rank, as well as outperformance was obviously very meaningful. But having said that, I do think that we had number of other opportunities that we missed. For example, we did not participate in the whole PSU rally, uh, and whether it was defense or other PSU sectors. And I think maybe if we had done that, we could have delivered even better returns. But I think it is more a issue of I think developing confidence around the names we evaluate, and I think sometimes it's just a matter of not being able to do the enough work that is required to to come up to that conviction, and that is where we feel, and I think the way we can address that is only by increasing our capacity in terms of the research capacity, and that's what we are doing. We are expanding our research team. We are, so I think, and we are also expanded our technology team, because they go hand in hand. Our analysts are enabled, to do their work more efficiently if we have good technology, and so I think that's something we continue to do, and I think we will continue to focus on in that area so that we are able to evaluate more opportunities in parallel, and hopefully further improve our success in that regard. Um, uh, I think someone has asked us to kind of just reiterate what is our overall pattern of equity investing. Essentially, we look at opportunities over with a horizon of 2 to 3 years, and we look for companies which have some clear strength in their business model. They have, in most cases, a strong growth opportunity. Their historical corporate governance has been robust. Management capability is sound. Their capital allocation decisions have been very good, and They've shown the ability to generate superior return on capital and cash flows, and also use those cash flows wisely. And after doing all that, they have to be available at a price at from which we can expect a minimum return that meets or exceeds our required rate of return. And our required rate of return can be anywhere between 12 and 20%, even more than slightly more than 20%, depending on the risk of the business, volatility of the stock, and so on. So that is sort of how we invest. So we buy only stocks when they meet this criteria, and occasionally we will also buy some cyclical turnaround situations or cyclical stocks available at a very cheap valuation below replacement value, or special situations. That will be small part of the portfolio. And we keep staying invested in the stock as long as incremental return for the future 2 to 3 years are still looking good. But if they start to look diminished, or low, then we start to exit. Or if we feel our thesis is not working, then also we'll exit. Another question, around, somebody asking whether, they have some capital to invest, but market seems overvalued. So he's not sure whether to keep significant amount of portfolio in debt, liquid arbitrage, or slowly invest in equity. I think to the extent that you have money available that you're not going to need for next 5 years, I would say invest in equity gradually. And I think, I definitely Indian equities are great, but I also think, if you have the ability to invest outside India as well in the US market, I think some allocation to US equities is also good. Because equities will give you the best returns in the long run. That is historically proven again and again. And so I think that's kind of what I do for my portfolio. In fact, I have even analyzed returns that I've received from other asset classes, including real estate, and I'm not, and I'm convinced that nothing beats the returns from equities. So that's sort of my take on it. And now, before I hand it over to my colleagues, Sneha, have I missed any questions so far?
No, you answered everything.
Okay, so I think some of the questions related to sectors, I'll hand it over to Pallavi to go with that. Pallavi, you are mute.
We can't hear you still.
We can't hear you. Can't hear you, Pallavi.
Devang, you want to go ahead? I think she is having some.
Yeah, so there were questions around stocks, sector specific queries. I'll just take them. Pallavi can join us. Any specific reason for us investing heavily on banks and NBFCs? That was one of the questions. So, uh, why we are invested heavily on banks and NBFCs is because the banking sector is a proxy to GDP growth, and we are having strong loan growth that was offset by margin headwinds last year, but now we are seeing asset quality is continuing to improve, and going forward we expect these margin issues to be abating as interest rates stabilize. And amongst private banks, which are in invest mode, we can see better cost to income ratios going ahead, and the RBI's recent backlash on fintech bodies and other high cost funding for NBFCs, uh, that bodes well for large banks. So our estimates are conservative, but we even with those kind of estimates, we find attractive opportunities in large banks.
And I think I'll also point out that, as a percentage, although we don't kind of do investing based on the index, financial sectors represent large part of the index. So that I think, I think in fact, while, it may seem like we are heavily invested as a percentage of the index, I don't think we are above that. Yeah, go ahead.
Yeah. The other question was, do you have investment opportunity in greenfield sector like semiconductor, EV, green energy, etc.? So the government focus on renewable energy is standing out, and stocks in that space have done very well last year or in recent years. However, the acceleration in growth is yet to come on the ground, and this presence will continue to present an opportunity that we are assessing continuously. There's a question on what are the opportunities in infrastructure space. So, this has been a volatile space with high churn amongst leaders and laggards, which makes it difficult to, play on a theme on a consistent basis. But we believe there are pockets here that offer stability and returns. For example, water space that we have played in the past, in this space. Is there emerging opportunity in aspirational consumption space? So again, there is opportunity in aspirational consumption theme that we are closely evaluating because as Bhavin Bhai said in the past, there is a lot of headroom for us to grow and grow consistently at a high pace in the long term. And as GDP per capita crosses a certain threshold, we will see very high growth in this segment as well. What is your point of view in defense sector, both public as well as private? So we believe, public defense sector offers better opportunity than private sector counterparts because of how much, scale up that the private sector still needs to do on to justify the valuations. We've evaluated some of these names in the past earlier, and like Bhavin Bhai said, we've passed on some of them, but we continue to monitor them and wait for better opportunities or them being available at the right value. The question was, which sectors are you bullish on post elections? So, pre-election there has been strong rally in real estate and capital goods sector, and going forward, we believe banking, healthcare, media, these are better risk reward ratio at this point of time. Post election, we need to reassess based on the outcome. Another question was, can we get some idea about potential investment candidates, at least in which sector? So, we'll refrain from taking specific names before we fully evaluated and had an opportunity to, build our exposure in such names. But we are looking at opportunities in consumption and chemical space more closely as of now. Another question was if this is similar to 2003 2008 cycle, as most people recall, then what is the possible? Uh, is it possible that asset intensive and PSU stocks will do better than what has worked in the last 15 years, like quality at any price? So, is this similar to 2003 or 8? Uh, what has happened is government has front-loaded investments in the last 2 years, and now it'll be hoping that private sector capex picks up going forward. And if that happens, then we'll see a sustained, upcycle in the investment a cycle. And if that is happening, then capital goods related stocks will have further room to grow. If we are, growing at 7-8% consistently, then that sector would be doing well. Just one, again, point of differentiation is versus 2003-8 cycle, there was a strong global growth, supportive growth environment at that point of time. The same sectors may or may not do well this time because there was also a lot of overinvestment, for example, in power sector or, a lot of crony capitalism and bad lending that happened in that point of time. And, subsequently, those sectors did suffer post that 2008 period. Uh, so opportunities could be in different sectors like sectors that benefit from China Plus One or Make in India initiative that the government is pushing. Which industries in India are flourishing and hence are target for investment? Like I mentioned earlier, Make in India manufacturing opportunities in sectors like electronics, defense, renewable clean energy or green energy like green hydrogen, which is the next would be the next big opportunity. Similarly, natural gas and clean energy, internet driven businesses, fintech and platform businesses, we are already seeing very strong growth. Again, also aspirational consumption, as I mentioned earlier, would have very high growth.
Yeah, Devang, I just want to cover a few questions that have come up in the chat that were directed at me. So let me handle those. And I think the first one was, current market, what should be the SOT allocation between large, mid, and small? Um, I mean, I think hard for me to say. I think I feel there is opportunities in all, and in general, we continue to find, if there are good opportunities in large, inevitably you end up finding opportunities in mid and small as well. So I don't feel we want to swing significantly in one direction or the other. Although given the valuations across the board in the market, the risk obviously will be higher. Impact will be higher in the small cap, and I think we are seeing that last 3 4 days as well. I think all I can say is that the because of having that mix, we have felt a lower impact or in those days. I think there was another question on why do we hold bank ETF in the portfolio. Um, and I think this is an important question. What it is, the reason this is a rare instance of we buying a bank, ETF. And I think if we did it by after looking at the portfolio weights of the stocks in that ETF, and essentially you are buying HDFC plus ICICI plus SBI, Axis and Kotak. And I think all these banks have either underperformed and has become attractively valued or are still doing well. And I thought that instead of adding too many bank stocks, it would be a good way to get exposure to this group of stocks that are doing really well, fundamentally, and I think reasonably valued. And that's the reason why we did that. I think there was a question on Sonata Software. We got the earnings quite wrong. Yes, I guess so, and that's why we took a corrective action as well. There's a question on a company where I mean, I wouldn't mention the name here because we still own it. That why have we been not more aggressive in buying? And I think it has the function of liquidity in the stock. We never no don't try to try to jack up the price by buying our buying, and I think that is the response to that. Um, uh, I think there was a question on another position we bought in the fintech space. Well, I don't think we have any reason to sell. And whether it's overbought or underbought, it's kind of technical aspects. It's not something we really understand. We like the business, and that's why we own it, and we hope that we continue to own it. With just a recent addition. Um, There's a question around youth unemployment rate in India and how does it compare to China during their growth years. I really don't know the answer to the question, to the precise, but what I know anecdotally is whoever I meet in the running the businesses, industries, they are finding it very hard to find people. So while there is some, clearly there is some unemployment, especially among educated youth, it's perhaps a result of a mismatch between the skills and the job availability. We ourselves struggle to find, people that meet our criteria, and I think so. And if I go down the curve in terms of this, the labor, the workers, the factory workers and so on, there is a significant shortage of workers, and then I think so. It is little bit of a I think of a skill gap issue. I feel for new investors, do you invest 100% of the proceeds or stagger the investment based on current? Definitely stagger. I think we stagger in two ways because only some stocks in our portfolio are at the point where we would buy today, and so we only buy those stocks. And secondly, even if we're buying, say we want to build a 3% position, we may do it in three steps. Instead of buying all 3% in one go, given the market condition. So that's really what we do. There is a question on uh, potential de-dollarization trend. How does it impact your medium or long-term strategy? I don't know if Ishwar, you want to take that. Uh,
Yeah.
mhm.
I think de-dollarization, has been a story around for a few years. And so far, I would say that there's not been any significant movement in that direction. Now, it is possible that certain countries, I think, for example, China has been accumulating a lot of gold. Russia has been kind of cut off in a lot of ways from, a lot of the financial markets. So it's possible that, there's more legs to it over time. But at this point, I would say that it's been more news than substance. But definitely to the extent that the US does use sanctions, to cut, countries off from, dollar-based kind of financial markets. That's something to watch, and these things come to the extent that you're on the wrong side of the United States in terms of where strategic things are. And often it's very extreme things, right? Like the Russian invasion of Ukraine. And I can see, China-Taiwan issue being another cause of it. Iran has suffered for many years, from that. But at this point, I would say it's something that we would watch, and it's not been anything which has a lot of substance, despite all the talk.
So I want to go to the question around underperformance of an investor who joined in November. I think Sneha, if you are able to put up the slide, it'll be good. And I think it is a function of how we invest. It is, this can happen. What happened is after somebody opened an account in October, we started investing gradually, and actually, market rallied very strongly in November and December of 23. So we had very high cash levels. We are very underinvested, and that contributed to that meaningful outperformance. Now, if the market had gone the other way, in other words, if some people who have invested recently, I think the fact that we have not invested aggressively would have worked in their favor over the last few days. So in the initial periods, this has happened to many investors, and I think we had such periods before as well. Hopefully, in the longer run, as it has been in the past, and I think I showed you one slide as well on this performance of investors across time. Hopefully, as we buy, continue to find opportunities at the right price. It should play out well for the investors. But yes, there has been underperformance for sure for investors who have joined, sort of 6 months back. Back to you. I think Devang, you still had some more questions to address, right? And then
Yes.
then Ishwar, yeah. Okay.
Yeah, there are now a set of questions around what process do we follow. One of them is that kindly elaborate on your risk mitigation strategy. Uh, this will be a longish answer. I'll try to keep it brief. Just like on the investing side, on the rules based, on the risk management also, we have a rules based framework in place, which will which puts exposure cap limits on stock. So firstly, for every individual position, we will have cap on what exposure we can take depending on how many days it will take us to say build a position or liquidate a position. So for example, if it is going to take us more than 30 trading days to build a position, then our exposure to that stock will be limited to 3%. Uh, uh, so in that sense, if it's a large cap, uh, we can build a position quickly, and we can have a higher exposure to a large cap, saving 10 to 15% position, because it's easier for us to build position in a large cap. Secondly, we have a rule on what percentage of the portfolio are we able to liquidate, say within a day or a week or a quarter or in the long term. So these numbers are hard coded, and effectively what that does is it sets some limit on how much small cap exposure we can own. Even though our strategy would allow us to be fully invested in small caps, but because of how much portfolio we should be able to liquidate in say a week or a quarter. That kind of limits how much exposure we can have to small caps. Thirdly, when we say how many days it takes to buy a position or liquidate, we calculate this, on a conservative basis, assuming that we are trading 15% of the normal volume of a stock. So, average daily volume of that stock in the past quarter is sort of an empirical number that we assume, because then when we are buying a stock, we don't want the stock price to be jacking up just because of our buying. And finally, all these rules are programmed in our execution software, so that if you are violating any of the covenants, there would be a red flag popping up, in the morning when we log into the order management system. So it's kind of monitored on a real-time basis. A question is on what are your thoughts on SME IPO space? Do you track companies that are small in your portfolio? So, I just like explained on our risk rules, depending on the liquidity, there are exposure caps on how much exposure we can take to a stock, and because of very low liquidity in SME stocks, it would not allow us to build a meaningful exposure in those stocks, so we don't track the SME space.
I think I just add, we may consider having a separate small cap, SME AIF at some point, but that would be the way to handle that, rather than given the liquidity, it would be difficult to invest in them in this in the PMS.
Yeah, there's a question on that. Do we meet management before entering in a totally new stock? So yes, we do meet that. In fact, that is one of the criteria in our elaborate investment process, which is to meet or interact with the management of our investee companies. There is a question of on how much is the minimum top up you accept in the portfolio. So there is no minimum amount of top up mandated by regulations, but for it to be a meaningful number, we would recommend that at least 5 lakhs is the minimum top up that is done. There is a question on how frequently have you planned interaction with us. So no, we aim to have this sort of interaction twice a year. There's a question on if we top up funds to our PMS, say 5 to 10 lakhs or some percentage, how long does it typically take to deploy it? The Bhavin Bhai is partly explained at various places. We do not follow a model portfolio approach, and we build the positions gradually based on the opportunities then. So there is no fixed time period for deployment, and it will vary depending on market conditions. If there is a correction in the market, then we could deploy funds rapidly as well. Moving on, there are a set of questions on performance. One of the question is, what is the ideal time span an investor should give to PMS fund manager for performance evaluation? How much time should one give to evaluate performance? So this is a product where one should at least look at returns at least on 3 years, but ideally more on 5-year basis. Another question is, I am noticing underperformance by our fund compared to benchmark and other PMS for the past 3-4 months. What is the reason? So if you look at our performance from Jan to April, that is 4 months, our performance is plus 9% against the benchmark of plus 8.1, 9.42 versus 8.1. So in April we had good performance. So cumulatively for 4 months, I think our performance is better than the benchmark. And there was a significant decline in the small cap index, which would have impacted us in March, because we have more than 50% of the portfolio in small cap, so that would have affected. But generally, if you see over the last 1 year, then in 9 out of 12 months, we have been outperforming, and on overall basis, there is an outperformance of 19.9% in the last 1 year. There is a question on how much is your cash position as of now. So the latest month end, the cash position is at around 9%. I think we've completed all the questions. Bhavin Bhai, if you want to add anything else.
I think Ashwar had a few questions on the US market. I remember.
Yeah. Can you take the screen share so I can off?
I can read out the questions if you want.
Can you? Yeah. Okay. Just remove the screen share so somehow I cannot see the questions. Yeah.
How do you see US equity markets playing out over the next 3 years? which sectors could play out well? What would be the impact on Indian markets?
Yeah, I think with the US market, I think many areas of, of the market are at a premium valuation. I think technology sector, anything which is AI related. Now the question is future growth, does it justify the valuation, right? So you've all heard the stories of, companies like NVIDIA, which have, just been phenomenal performers. Often backed up with real revenue, right? In the case of NVIDIA, I mean, they're the only company which produces the GPUs that everybody uses in terms of machine learning, etc. Now, other segments, of the market, which are more kind of the traditional economy, those have not necessarily participated in this rally. And, as I remarked at the start, if companies don't deliver on earnings, they kind of get punished, I mean, quite severely. So I think it's a mixed market. I think overall, in terms of the market, I would say that just given the strong performance, that I would say returns would be modest, maybe slightly below par. But the opportunity in the U.S., just like in India, is that it's a very, it's a broad market, it's a very deep market, and for stock pickers, there's always opportunities. So I would say risks in certain areas, particularly if kind of the AI story doesn't play out, if companies don't deploy these things very quickly, maybe that segment of the market has some risk. But overall, I would say maybe modest returns, but I don't see any significant risk, at least based on kind of seeing what's out there currently. Impact on India, I mean, obviously there's direct impact. Indian IT companies depend on, US, tech spending. So that could be an issue. And if you looked at, you've seen that at least maybe traditional tech, maybe there's been a slowdown, but anything AI related, there's actually been acceleration. So it really depends on the exposure that you have there. And to the extent that Indian companies export to the US, etc., I think the health of the US economy probably is a factor. And that continues to outperform, its peer group, which is Europe and, kind of developed Asia. So there are opportunities there. Expectations from the US market, like I said, the market is broadly fairly valued, but certain segments are probably overvalued. In terms of, let's talk about non-equity markets for a minute here. I still think that there's probably one or two rate cuts, that will come. Probably in the next few months, because the Fed doesn't want to act too close to the presidential elections. And I think that's related to the fact that even though I did say that inflation is a bit sticky, a bit higher than it was before COVID happened, I still think that the real rates are a bit higher than they could, they should, maybe should be. So expect maybe 25 basis points, 50 basis points, rate cut. Now, one area of concern, I touched on this before, is fiscal spending. I think spending is too high. It's too pro-cyclical at this point, meaning that, you have a healthy economy. So why should the government be spending all this money? So that is a concern, especially as the debt levels kind of increase. Consumer spending has always been a support for the US market. There is some signs that maybe that's slowing down a bit. So that's something to watch. Unemployment level is very low. So expectations broadly, I would say that, I think it's a deep market. So I think it's a stock pickers market. Areas, a lot of opportunities in certain areas. Certain areas are overvalued. So, I think really focus on opportunities in specific areas in the US market. US elections, it's still a bit early. I think if you looked at the polls, they seem to show that at least the presidential election that Biden was behind. Recent polls have suggested that he's closed the gap. I think if you look at the betting markets, it suggests that I think President Biden is favored somewhat to beat Donald Trump. I think the more important factor is, what happens in Senate elections, House, the Congress, etc., because I think you really need control of all three parts of it to be able to have an agenda that can pass. And that also is too early. I think it's likely that the Republicans, maintain the House of Representatives and maybe take back the Senate. So then it really comes down to whether Biden wins re-election or Trump wins the election. If Trump wins, probably it's, at least in the short term, maybe a positive for the markets, in the sense that you may get, kind of market supportive measures. If, as I said, Republicans get back the Senate and win the House of Representatives. Though there are long-term issues, just in terms of, how Trump, reacts to constitutional issues, etc. So I would say a mixed picture. At this point, I would say it's probably not going to be a big deal, right? In terms of what happens in the elections. Global trends and how it impacts the Indian equity market. We've often talked about the fact that, the Indian market has a lot of domestic drivers. Exports as a percent of GDP is not necessarily a big number. So India's growth is, happening in a way which is slightly different from China. China was very much, driven by exports and also infrastructure spending. Indian infrastructure spending is increased. That's a positive. Exports is also increased, but it's obviously not an export-driven kind of an economy. So the domestic drivers are important. So in terms of what happens in the global markets, I think a significant global downturn, would be an issue, right? So if economic growth slows down dramatically, kind of like what you saw briefly during COVID, what you saw for a period during the great financial crisis, 2008, 2009, that will be an impact in India. But other than that, if you have a modest global recession, Indian growth would slow down. But my guess is that growth probably would not slow down, beyond maybe a 5% kind of a level. Now, other global factors, I think we briefly touched upon commodities, particularly crude oil, because India is a big importer of crude oil. So anything which results in a spike in terms of oil prices, that would be a negative. On two fronts. One is just the cost of imports. Second is inflation, and therefore maybe interest rates, etc. So at the first order level, I think India is kind of shielded from a lot of global stuff, but any significant economic downturn or kind of a Middle East kind of an issue which raises commodity prices, particularly oil, that would be a negative for India. Back to you, Bob.
Yeah. There is one question in the chat. I'll just highlight that. Why does our PMS have a lead time of 30 days uh, before we disclose the trade compared to some of the competitors who disclose it on a daily basis? Yeah, Bhavin bhai, I can take that. So, we have 54% weightage in small caps. So there are uh, quite a few small cap stocks that we own. And as Bhavin bhai had mentioned earlier, we build our positions gradually in the stocks. Sometimes the liquidity does not allow us to build a position very quickly. So it's only fair, that we don't these names don't get disclosed. Otherwise, uh, the price could jack up for those stocks. So it's just in fairness for all investors. And with that, we've answered all the questions that we had received, and hope we have been, able to clarify adequately on the queries that investors had sent in. In case there are any more doubts, especially relating to process or individual accounts, you may kindly, reach out to us by dropping a mail on wealth@sameeksha.capital. I'll repeat, email ID is wealth@sameeksha.capital. Okay, with that, we'll end the session now. Thank you everyone for joining in, and have a good day.
Thank you.